Stop what you're doing right now. Close the trading app, turn off the financial news, because what I am about to show you is not what they told you happened on February 13th. It is what actually happened. And if you do not understand the difference between those two things, you're going to make a very expensive mistake in the next 30 days. The headline you saw yesterday morning said, "Inflation cooled." The market celebrated. Gold surged 2.5% in 90 minutes. Silver jumped nearly 3%. Every analyst on television called it a win. They said the Fed can cut rates now. They said the data supports easing. They said the economy is healing. But they did not show you page 7 of the report. They did not show you the number that matters, the number that tells you inflation never left. It just moved. This is not a victory. This is a trap. The people who said it are counting on you not reading past the headline. Let me show you what actually happened. On February 13th, the Bureau of Labor Statistics released the Consumer Price Index data for January. The headline number came in at 2.4% year over year. Core CPI, which excludes food and energy, came in at 2.5%. Both numbers matched or slightly beat expectations. The market saw those numbers and did exactly what it was programmed to do. It bought gold, it bought silver, it priced in rate cuts. Within 90 minutes, spot gold rose from $4,920 per ounce to $5,041. That is a $121 move. That is 2.45%. Silver moved from $75 to $77.32. That is 2.83%. Platinum jumped 3.2%. Palladium surged 4.88%. Everything the textbooks say should happen when inflation cools happened. Lower inflation means the Fed can cut rates. Lower rates mean non-yielding assets like gold become more attractive. The dollar weakens. Real assets strengthen. It is clean. It is logical. It is exactly what the algos are designed to execute. But here is what they did not tell you. Here's the number buried in the appendix of the report that no one is talking about. Supercore inflation. That is inflation excluding housing costs. The measure that tells you what is actually happening to the price of goods and services people buy every single day. That number did not cool, it exploded. Supercore inflation in January jumped at the fastest monthly pace since last January. On an annualized basis, it hit 7.3%. 7.3, not 2.4, not 2.5, 7.3%. Think about what that means. It means that if you strip out the largest and most manipulated component of the CPI basket, which is housing, the real inflation rate is running at more than triple the headline number. It means the cooling you saw in the headlines is a statistical artifact created by how shelter costs are measured. It means the inflation that actually affects your purchasing power, the inflation that shows up when you buy food, when you fuel your car, when you pay for services, that inflation is accelerating. And the market ignored it completely. The algos do not read page 7. The algos read the headline. They see 2.4%. They execute the buy program. And retail investors, watching their screens, seeing green candles, assume the data must be good because the price is going up. But the professionals, the ones who actually read the full report, the ones who run the big money, they know what just happened. They know the Fed is trapped, and they are positioning accordingly. Let me explain the trap. The Federal Reserve has two mandates: price stability and maximum employment. For the last 2 years, they have been fighting inflation by raising interest rates. They took rates from near zero to over 5%. They held them there. They crushed demand. They broke the housing market. They triggered a wave of layoffs in tech. And it worked, sort of. Headline inflation came down from 9% to 2.4%. But the employment picture is deteriorating fast. The November jobs report, which was delayed and finally released this week, showed the economy added only 70,000 jobs when analysts expected 130,000. Unemployment ticked up to 4.6%. Revisions to prior months showed the economy actually lost jobs in October. The labor market is weakening, so the Fed is stuck. If they keep rates high to fight the 7.3% supercore inflation, they risk pushing unemployment higher and triggering a recession. If they cut rates to support employment, they risk reigniting the inflation they just spent 2 years trying to kill. And the market just told them exactly what it expects them to do. The market looked at the 2.4% headline, ignored the 7.3% supercore, and priced in 60 basis points of rate cuts by the end of the year. The market is betting the Fed will prioritize employment over inflation. The market is betting the Fed will cut, even though real inflation is still running at 7%. And if the market is right, if the Fed does cut rates while supercore inflation is at 7.3%, then every single dollar, every euro, every yen sitting in a bank account or a bond just lost more purchasing power. And the only rational response to that reality is to move capital into real assets, into things that cannot be printed, into things that hold value when currencies debase. Gold, silver, platinum, hard assets. That is why gold jumped 2.5% in 90 minutes, not because inflation is cooling, because the market just realized the Fed is going to choose inflation over recession. And that choice, that policy decision, is the single most bullish setup for precious metals in a decade. But it gets worse, because this is not just a US problem. This is global. Every major central bank on the planet is facing the same impossible choice. The European Central Bank is dealing with stagnant growth and sticky inflation. The Bank of Japan just ended decades of negative rates, but is terrified of triggering a debt crisis. China is battling deflation in some sectors, and inflation in others while trying to manage a real estate collapse. Every central bank knows that if they tighten too much, they break something, and every central bank knows that if they ease too much, inflation comes back. So they are all choosing the same path. They are easing. Slowly, carefully, but they are easing, and every basis point they cut, every liquidity injection they deploy, is another confirmation that the currency system is in managed decline. That is why central banks are buying gold at record pace. In the last 3 years, central banks have purchased over 3,000 tons of gold, over 1,000 tons per year. That is the highest annual buying rate since 1967. These are not retail investors chasing momentum. These are the institutions that print the currency. And they are converting that currency into gold as fast as they can without crashing confidence in the system. Think about that. The people who control the money supply are buying gold. The people who set interest rates are buying gold. The people who have access to every data point, every internal model, every classified briefing about the true state of the economy, they are buying gold. And they are not selling it. India just repatriated 280 tons of gold from London vaults. They physically moved it, put it on planes, flew it home, stored it in domestic vaults. Why? Because they do not trust that it will be there when they need it. Because they watched what happened to Russia. Russia had $300 billion in foreign reserves. The West froze it, took it, used it as a weapon. Every central bank on the planet saw that and asked the same question. If they can do it to Russia, can they do it to us? And the answer is yes. So they are moving their gold home. They are converting dollars into metal. They are building physical reserves that cannot be frozen, cannot be sanctioned, cannot be seized by executive order. Germany still has 1,336 tons of gold sitting in the Federal Reserve Bank of New York. That is worth $194 billion. And the former head of Bundesbank Research just went public in January 2026, saying it seems risky to store so much gold in the US given the current geopolitical situation. That is the establishment validating what a lot of people have been feeling for years. Foreign vaults are not safe. Meanwhile, JP Morgan just raised their gold price target to $6,300 per ounce by the end of 2026. Goldman Sachs is projecting $4,900. Bank of America is calling $5,000 the new floor. These are not fringe analysts. These are the largest financial institutions on the planet, and they are all saying the same thing. Gold is going higher. But here is what none of them are saying out loud. Here's the part that makes this setup truly dangerous. The reason gold is going higher is not because of some technical breakout or seasonal demand pattern. The reason gold is going higher is because the system is failing, slowly, quietly, but failing. You cannot run trillion-dollar deficits forever. You cannot print 40% of all dollars in existence in 2 years and expect no consequences. You cannot have a national debt of $38 trillion growing by $2 trillion per year and pretend the math works. It does not work. Everyone knows it does not work. And the only way to keep the system functioning is to devalue the currency faster than the debt grows. That is the plan. That is what the Fed is doing. That is what every central bank is doing. They are not trying to stop inflation. They are trying to manage it. They are trying to keep it just low enough that people do not riot in the streets, but just high enough that the debt becomes easier to service over time. And that plan requires gold to go higher. Because if gold stays flat while currencies debase, it breaks the illusion. It exposes the con. It forces people to ask why a metal that does nothing, that pays no dividend, that generates no cash flow, is worth more today than it was a year ago. And the only honest answer to that question is that the currency is worth less. So gold has to rise, not because of demand, because of mathematics, because the alternative is admitting the currency system is broken, and no central bank will admit that until they have no choice. Silver is the leverage play on that exact thesis. When gold moves, silver moves harder. Percentage-wise, volatility-wise, always has. Always will. In the last 2 weeks, silver recovered 35% from its February lows. 35% in less than 2 weeks. Gold recovered 15% in the same period. Silver moved more than double. That is not random. That is structure. Silver has a smaller market, less liquidity, more industrial demand. When money flows into precious metals, it flows into gold first, then it overflows into silver. And when it overflows, it moves the price violently. But silver also has something gold does not have. Industrial consumption that destroys supply. Every ounce of silver that goes into a solar panel is gone. It cannot be recovered economically. Every ounce that goes into an electric vehicle, into a 5G antenna, into a missile guidance system, it is consumed, permanently removed from the tradable float. Gold gets hoarded, silver gets used. And the rate of use is accelerating. Solar installations are growing exponentially. EV adoption is ramping. Data centers are being built at record pace. All of them require silver, lots of it. And the mining supply is not keeping up. For 6 consecutive years, global silver demand has exceeded supply. The deficit is being filled by above-ground stockpiles. But those stockpiles are finite, and they are shrinking. That is why the Shanghai premium exists. That is why physical silver in China trades at a $7 premium to paper silver in New York. Because Eastern buyers know the metal is running out. They know the vaults are draining. And they are willing to pay more to secure physical delivery before the system runs dry. The COMEX has 103.5 million ounces of registered silver. That is the metal available for delivery. But open interest on March contracts alone is 429 million ounces. That is a 4-to-1 ratio. 4 paper claims for every ounce of real metal. And if even 25% of those contracts stand for delivery, the exchange is underwater. They have been managing this problem for years, rolling contracts forward, encouraging cash settlement, draining the SLV ETF to cover shortfalls. But the math is tightening, the room for error is shrinking, and March 1st is notice day. That is when contract holders declare whether they want physical delivery or cash. And if delivery demand spikes, the COMEX faces a crisis. That is the setup. That is why Wednesday's CPI data matters. Not because inflation is cooling, because the market just confirmed the Fed will ease anyway. And when the Fed eases, with supercore inflation at 7%, every rational actor moves capital into hard assets, into things that cannot be printed. The professionals already know this. That is why gold jumped in 90 minutes. That is why JP Morgan raised targets after the data. That is why central banks are buying at record pace. They are not waiting for confirmation. They are positioning ahead of the move. Retail will wait. Retail will read the headlines. Retail will assume the experts have it under control. And retail will buy gold at $6,000, wondering why they did not buy it at $5,000. This is not financial advice. This is pattern recognition. The data says one thing, the market does another. And the gap between those two realities is where the opportunity lives. Verify the CPI report yourself, read past the headline, look at supercore, look at the methodology, look at how shelter costs are calculated, and then ask yourself if 2.4% is the real number. Check the central bank buying data. It is public. It is updated quarterly. They are buying over 1,000 tons per year. That is not speculation. That is fact. Check the COMEX registered inventory. It is published daily. 103.5 million ounces. Check the open interest. 429 million ounces in claims. Do the math yourself. The ones who verify will see what is building. The ones who dismiss will learn later when prices are higher and their purchasing power is lower. The warning is here. The data is public. The question is whether you are the type who checks or the type who waits for permission.